It's Thursday, 15th of January, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, China in the AI race. Is it poised to overtake the US? But first, we usually record on a Friday. We're doing it a day earlier in deference to the travel schedule of Group Chief Economist Neil Shearing, who joins us from a quietish spot of Changi Airport in Singapore. Hi, Neil.
Quietish, yeah. Hi, David. I find the quietest spot I can find. But I have to say, the airport's pretty busy. If you're judging the health of the global economy by travellers going through Changi Airport, there's pretty good health, I'd say.
There you go. There's a gauge. I can think of worse airports to be waiting for a flight in.
Indeed.
Look, it's been a busy week. The news cycle really has kicked into gear in 2026. I can't believe just the sheer volume of things that have happened since the 1st of January. But the week began, the big news was this Department of Justice investigation of Jerome Powell, his very, very public pushback. The biggest attack by the Trump administration on the Fed so far. Now, as we come towards the end of the week, it does sound like that's petering out. White House appears to be in full damage limitation mode. But this all speaks, doesn't it, to this worry about institutional degradation. And it comes amid these threats on US allies. I'm thinking specifically, obviously, of Denmark, of NATO, all around sovereignty of Greenland. Putting it all together, there is this argument for de-risking from the US to shield investors, to shield themselves from the Trump agenda. What do you make of all that?
So it's certainly alarming when you look at the headlines, isn't it? And I think it feeds into this concern that we've had for a long time, and we've discussed in the podcast about institutional degradation and a shift, the kind of orientation of policy in the US. But I think it's important also to separate out the different strands of risks here. And it's, in some senses, actually, is despite the alarming headlines over Greenland and those kind of shocking scenes, in some senses, of the US extraditing a sitting president, a leader of sovereign states. Actually, it's the Fed, attacks on the Fed, that are potentially the more significant from the perspective of the global economy and markets. Now, as you say, at the back end of the week, it looks like, certainly the Fed has rallied around Powell, and other central banks have rallied around Powell, and the White House has rode back. And if anything, it looks like that's kind of entrenched Powell's position, then increase the chances that he stays on as a Fed governor even after his term as Fed chair ends in May, and potentially raises the bar for approving Trump's pick in the Senate. So in some senses, it looks like the guardrails are just about holding. And indeed, we put out a piece after that extraordinary press statement by Powell saying we thought actually the Fed's independence would stay intact. And if anything, it strengthened his position at the Fed. I think that's broadly played out this week. As for de-risking from the US, I think it sounds all very well and good in principle. In practice, it's incredibly difficult to do. The US dominates financial markets to an extent that no other economy does in the world. It's the world's biggest equity market, the world's biggest bond market. It has some of the world's fastest growing and most profitable companies. So investors might wish to kind of de-risk, but they certainly can't decouple from the US. So I think that there's a slight sense in which looking at the kind of financial headlines, the financial press, there's a bit of hyperbole around what's going on in the US. Attacks on the Fed, I think, are concerning. But if you're an investor, can you decouple from the US entirely? No, of course you can't. So in some senses, it's about managing risks rather than completely decoupling from the US in its entirety.
I find the phrase guardrails just about holding a bit concerning, given that, Powell's tenure is going to end in May. We're going to get a new Fed chair in, and our chief North America economist, Paul Ashworth, has warned that the new Fed chair, whoever that may be, is going to be at loggerheads with Trump almost immediately because of the president's desire to get much, much lower interest rates, and the FOMC's view that that's simply not warranted given the US macro environment.
Yeah, indeed. And of course, then the political calendar collides with the economic cycle, because the US economy is doing pretty well at the moment. We've had that big surge in productivity growth that's underpinned economic growth in the second half of the year. Inflation in the latest readings was relatively benign, but still running at above target consistent pace, we think, for the December core PCE numbers when they come out. And then you run into the reality of midterm elections and the focus shift into the midterm elections in the second half of this year. And clearly there's going to be pressure coming from the White House to lower rates ahead of those elections. So not only is it the case that the new Fed chair is going to potentially be thrown into conflict with the White House over rates, the pressure on the Fed itself is going to increase, I think, as you move close to those midterms at the end of the year, which clearly Trump's viewing as critical that the Republicans hold both houses of Congress.
Okay, so you don't buy into the decoupling argument, but I do want to run with it a bit more, because part of that argument about de-risking or about decoupling from the US is about moving closer towards China as a more responsible economic partner, as a more responsible trading partner. That's very much the messaging from Beijing. You can't rely on Washington. Look to us, partner with us, and basically we'll look after you. And then you look at China's trade surplus, full-year trade surplus, $1.19 trillion, confirmed this week by data from the Customs Administration. It is what some of us Brits would call a stonker. It's what others would call a shocker. What's the capital economics take?
Well, I think if you're thinking about the health of the global economy, and one of the kind of fundamental strains and tensions at the heart of it at the moment, it is these mounting global trade imbalances. The central to that has been the expansion of China's trade surplus, as you say, now $1.2 trillion. And it does stand, I think, there's a tension between China's kind of political outreach to traditional US allies. So we've seen Starmer going to China for the first time a UK Prime Minister visited China since 2018. Mark Carney, Friedrich Merz, all reaching out to China and appearing that the relations are warming between traditional US allies in China, and then this enormous trade surplus. And if you look at the counterpart to that, clearly every surplus has to have a corresponding deficit. And yes, the US still has the largest trade deficit in the world, despite Trump's tariffs. But we've also seen a substantial deterioration in Europe's bilateral trade position with China. And it looks like China has taken market share from European exporters. So if you look at how the share of global export markets has shifted over the past 5 years or so, actually China's share has increased, but actually countries elsewhere in Asia have also seen slight pickups in their export share too. It's been Europe that's been squeezed by Chinese competition. So there is clearly a tension there between what's happening on the kind of political outreach front, the political front, and the economic front, where I think that will temper the extent or limit the extent to which there's a full reset or a cross-run between US allies and China. And yes, China's positioning itself as a kind of responsible stakeholder at the heart of the global economy, while running mercantilist policies as the world's second largest economy. Those two things are really inconsistent.
And it all comes down to an economic policy and an industrial policy run by Beijing that doesn't show any signs of changing. You talked about the impact on developed market trade terms, or the impact on Germany. There's this impact on Japan. But you look at emerging markets, you look at what's happening with emerging markets and how, yes, China is eating up market share in high-end industries like electric vehicles and batteries, but it's not giving up really the share in low-end things like carpets and toys and tobacco. That's not how EM development is supposed to work. So Beijing's messaging, politically, yes, we are a responsible economic trading partner, a counterpoint to what's happening in Washington. Fact is, its industrial policy is a threat to economies, developed market economies, but also to emerging market economies. How does this play out?
Well, I think you have to separate countries into different buckets. So you're right that in a very real sense, it's now a threat to developed market economies because China is challenged in them in high-end export goods. So Germany has gone from a position where China's been a large export market to where it's now an export competitor. At the same time, you have some emerging economies where you're right, China's not really relinquishing market share in low-end production. So that's squeezing out production at the bottom end of the value chain. But there's also some emerging economies that are actually benefiting, not necessarily from the economic model that China's pursuing, but from the geopolitical dislocation in the global trading system. That is to say, firms deciding to move production out of China and into countries that are potentially a bit more geopolitically aligned with the US, so Vietnam, Thailand, India, and so on. So in South and Southeast Asia, actually, you have some countries whose export market share has actually increased over the past 5 years. And in those countries, actually, and I'm in one at the moment, Singapore, the concern here really is not so much about export competition from China, but just the general direction of China's economy more generally, the health of the economy more generally, and whether this price deflation in China, this deflationary environment that's stemming from a high savings, high investment growth model that's putting downward pressure on prices and generating export competition. The flip side of that is it's a deflationary environment in China. Nominal GDP growth is extremely weak, and that depresses returns for investors in the region into China. So the concern here is not so much about export competition, but price deflation in China, depressing investment returns in China. Of course, that's the big concern too. In China is kind of low growth and deflation. So you've got three buckets of countries really that have different concerns about China. You have the high-income countries that are now being squeezed in high-end export markets. You have low-income emerging economies that are concerned about China's export domination in those low-end goods and not ceding market share as they're gobbling up market share at the higher end of the value chain. And then you have some economies in South and Southeast Asia that have gained some market share in export markets, despite price competition from China, because they benefited from the relocation of global supply chains, but are instead worried about the general deflationary environment in China and the weakness of growth there. So every which way you look, I think there are concerns building about China's growth model and the consequences of that rippling out throughout the global economy.
Pick you up on that point because you've been in Singapore last few days. Turns out Bank of England Monetary Policy Committee member Alan Taylor was in Singapore as well this past week, gave a speech talking about disinflation in the UK in 2026. Quote unquote, exports that can no longer go to the US from China may now flow to other places. Current data shows that's happening. This would be a case of trade diversion. His point is that it could bring UK inflation down by more than the 0.2 percentage points that the BOE is forecasting in 2026. So there are disinflationary benefits for DMs from what's happening with China's industrial policy. I mean, how far can we run with that?
Indeed. And that's always been the kind of conundrum, hasn't it, at the heart of globalization, is that the consumers benefit from lower prices and central banks like lower prices if in the goods markets because that helps them meet their inflation target. But the flip side of that is pressure in export markets that creates pressure on jobs and production and industry in advanced economies. That's exactly what's playing out. And that's the conundrum at the heart of all of this. Now, I wouldn't put too much emphasis on all of this being a substantial disinflationary force in developed market economies. So it's true to say that China has cut its export prices. Chinese firms have cut export prices over the past 3 or 4 years, down about 20% since 2021. But if you run those numbers and then you look at China's export share in global markets and the consumption in various advanced economies of Chinese goods, then I think it knocks something like 0.1 to 0.2% off the CPI level each year for the past 3 or 4 years. So it's knocked kind of 0.1 to 0.2% off of inflation relative to the situation that would otherwise have prevailed. So, it's helpful if you're the Bank of England, but really we're talking about inflation dropping from kind of 4% this time last year to 2% in the UK by April. And why is that? It's because a lot of the one-off effects that pushed up inflation in 2025 are dropping out of the annual comparison. So the big fall in inflation that we're anticipating in the UK this year is helped by price competition from China and the effect of cheaper imports from China, but it's not really the big factor here.
To the extent that there are disinflationary benefits from what's happening with Chinese goods exports, is there a case that perhaps the US won't benefit as much because of the trade barriers? And following on from that, let me put this to you. This is from the Xinhua readout of a press conference Customs had earlier this week when they were publishing the full year trade data. And they said, quote unquote, it should be noted that some countries politicized economic and trade issues and restricted high-tech product exports to China under various pretexts, without which China would have imported even more in 2025. In other words, if there hadn't been these trade barriers, these Trump tariffs, China's trade surplus wouldn't have been so big last year. What do you make of that?
Well, it takes a bit of chutzpah for the Chinese to criticize trade policy for being politicized, I think is one point you could make. There was a very real sense in which it's true to say that the issue with China is not really so much that it exports so much, but that it imports too little. However, I don't think it's really tech controls and export curbs that are preventing China from importing more. Rather, it's the fundamental problems at the heart of China's growth model, right? It's the fact that domestic savings are too high, domestic consumption is too low. And yes, in the absence of export curbs, perhaps China may have imported some more advanced semiconductors, but you've got to bear in mind that actually there appears to be some evidence that Chinese policymakers have put pressure on importers not to take advantage of the ability to import advanced semiconductors from the US and rather to rely on domestic production. But also, I think it slightly misses the point. The issue here is that consumption in China is more generally is too low. That's not consumption of semiconductors or advanced technology. That's consumption more generally as a share of GDP. So yes, it's correct in the diagnosis that China needs to import more, but the fact that China is not importing more has nothing or relatively little to do with export curbs on goods to China. They're more to do with the fundamental strains at the heart of the current growth model.
Neil Shearing there from a departure lounge in Singapore on China's trade surplus and the global economy. One of our non-consensus calls for China in 2026 is that trade surplus is going to keep growing as a percentage of GDP rather than flatlining as most expect. I will add our note about China non-consensus calls in 26 to the podcast notes. In the coming week, we've got a drop-in, that's one of our short-form online briefings, all about our latest update on how the geopolitical map has shifted over the past year and what that means for the global economy. Mark Williams, our chief Asia economist, is going to walk clients through our global fracturing dashboard and highlight key trends and the big risks to watch. That session is on Thursday, 9 a.m. New York, 2 p.m. London, so do sign up for that. Again, registration details in the podcast notes. Now, this Tuesday marks the first anniversary of the launch of DeepSeek's R1, a large language model which stunned the industry with its performance and its cost effectiveness. Its launch marked China as a serious competitor to established US models such as OpenAI's ChatGPT. But how much progress is China making against the US in this technology arms race? And how is that affecting the Chinese economic outlook? A new in-depth report from Leah Fahy from our China desk provides answers, and I spoke to her about it earlier. Here's that conversation now, and it begins with Leah talking about a recent forum in Beijing where some of the leading figures in China's AI industry were talking about the gap between the US and China in AI and how far behind China is.
Speeches and discussions about all sorts of things. Obviously, one of the interesting highlights is, they did say something along the lines of, it's possible that the gap is widening, even though you're not seeing that in models, just because of this hardware gap particularly. But also a bunch of them, when asked things like, so where do you see AI ending up? Like, what are the odds that, China starts beating out the US over the next, I can't remember if it was 5 years or something along those lines. They're giving like at least 20% chance, a bunch of them.
Yeah.
So I think it's which headline you want to pull from that, really.
There's a sort of lobbying aspect to that.
Yeah. That too.
But lobbying for what? For Beijing to ease restrictions on Chinese buying the chips that the US has eased restrictions on selling, or?
Yeah, I think that's a big part, because what's interesting is that before these chip restrictions were kind of eased on the US side, you had the likes of NVIDIA saying China's really closing the gap. They're really, really close. So regardless of what we do from the US side, China's going to catch up in AI. So the best that we can do is ease these chip restrictions, get the Chinese hooked on our chips because they are still better. And then at least we kind of have some control over supply chains, and then that degree of kind of oversight and, as I said, control over Chinese AI development. And then you're kind of seeing the opposite happen now to some extent. So the US has eased these export restrictions on the H200s, which are not quite their top chip, but one of their best chips, saying that NVIDIA can export this chip to China now. And then it sounds like, it's not been confirmed officially, but it sounds like Beijing is trying to put pretty severe restrictions on the imports of those chips in an attempt to try and get domestic AI companies to continue to rely on domestic chip manufacturers and, in that way support domestic chip development. And then, as you say, kind of in response to that, you're getting heads of big Chinese AI companies highlighting the fact that the US is so far ahead. They're probably pulling farther ahead. The gap isn't closing. Hardware is a big issue there. And yeah, I think there's probably a big proportion of that, which is them kind of trying to nudge Beijing and to convince them that these chips are needed and are important. Because when it comes down to it, I mean, the gap between the top US chips and the top Chinese chips is still pretty massive.
But is that, I mean, from Beijing's perspective, you can be sympathetic because if the US is saying, no, let's sell them the chips because then we can essentially get them addicted, hook them to our technology, they then won't be able to purge it from their tech stack. From a national security perspective, you can imagine someone in the party going, well, hang on, that leaves us incredibly vulnerable. And if the whole goal of this is to achieve dominance in this technology, then it would make sense to restrict access to the US chips and to encourage domestic industry to step up.
Yeah, exactly. And that's kind of been kind of a key facet of China's AI strategy in recent years, right? I think it's important to understand. I think from maybe a Western perspective, domestic technological development, getting to that frontier, being the first, etc., is the most important thing. Obviously, that matters to Beijing, but I think self-sufficiency is just as, if not more, important. We're talking about a country that sees itself essentially as in existential competition with the West. There's a lot of AI has loads of different potentials to drive much more rapid economic growth for one thing, but there's loads of military applications as well. And China clearly sees this as this big growth industry going forward. And when you couple that with its view about its relationship with the West and its desire to be independent, I think trying to ensure that AI development domestically happens in a way that's relatively self-sufficient from the US and from the West more broadly is quite important.
The analysis, the report that you put out makes the point that actually China has caught up enormously with US AI models, despite not having access to the most cutting-edge AI technology.
Yeah.
How far can that go?
$1 million question, isn't it? I think there's still quite a lot of scope. So where we're at in terms of chip design and gains in chip compute capacity, obviously there's continual gains being made. NVIDIA chips are continuing to pull ahead of Chinese ones, and the Chinese are struggling to keep up. That's compounded by the fact that the US has restricted access to lithography machines, actually produced by the Dutch, but anyway, through US export controls, which are a key machine that's used in AI chip manufacturing. And China doesn't have access to these best ones. So they're trying to kind of stretch the capabilities of the ones that they've stockpiled so far. So China's ability to kind of continue to develop better and better AI chips is somewhat dependent on its ability to develop better lithography machines, continue to stretch the ones it has, and so on. And obviously kind of this compute gap with the US will make it harder to catch up model-wise. But I think one of the more interesting parts of the research was that compute's important. It's obviously kind of one of the key determinants of model training capacity, but you actually get kind of sublinear returns to compute. So in other words, as your compute capacity increases, the actual kind of model training gains you get start to diminish. So essentially the point is China obviously lags quite significantly in compute. It's not clear. I mean, there's obviously potential for gain there, but it's not obvious that they're necessarily going to be able to make up that ground. But there's loads of ways they can still close the gap when it comes to actual AI models. So part of that is because of this kind of sublinear relationship between compute and model performance, but also, they can leverage things like algorithmic efficiency, which is what we saw with DeepSeek. So, far less compute required to get the same kind of model outcomes, as well as things like data quality. And I think what's been clear over the past few years is that Chinese tech companies are really good at working within the constraints that they face and developing really good models. And so that's probably a trend we're going to continue to see going forward.
One constraint that the Chinese probably don't face that US AI leaders do is this question of energy, access to energy. It astonishes me just the scale of the build out of China's energy grid. So in 2025, apparently around 500 gigawatts of capacity was added, which is 5 times California's total capacity and the whole of India's energy capacity. Is a Chinese advantage? I mean, how does this help China in the AI race relative to the US?
Yeah, massively. I think this is probably going to be most important when it comes to kind of the actual rollout of AI across the economy. Obviously, it's really, really energy hungry. And an issue that you've been seeing in the US already is that the energy grid just can't keep up. So in the US, you haven't actually seen loads of capacity additions over the past 20 odd years. Whereas in China, as you say, we've seen this kind of exponential increase. So that what that means for China is there's already loads of spare capacity in the grid that it can employ for both for AI model training and applications as well. It also means AI use won't necessarily drive kind of the surge in electricity prices that we're likely to see in other places like the US. Well, we've already had stories in the US of, data centers having to delay coming online because they can't be connected to the grid yet. And so that's obviously kind of a clear constraint that's going to be facing the US in the years ahead. And, it's obviously one thing to have the topmost cutting edge models, but it's another question whether you have, the energy capacity to then deploy them. And that's where China stands out as having a clear edge.
At a basic level, it comes down to efficiencies, doesn't it? At a basic level, you've got US AI firms investing in the hundreds of billions of dollars a year in this build out.
Yeah.
You've got Chinese firms investing in the tens of billions of dollars.
Yeah.
So on paper, that would suggest that there is some US advantage of the sheer volume of capital that US firms are able to deploy relative to Chinese firms. But there is a lot of nuance in there in terms of how the chips are being used, in terms of how the tech stacks are being used, in terms of energy capacity.
Yeah, I think one of the points that people often bring up is that the scale of investment in the US just absolutely dwarfs China. So to that extent, it looks like it's going to be a lot harder for Chinese companies to catch up to what the US is doing. Now, that's not untrue, but I think a lot of kind of the apparent difference on paper comes down to how kind of investment and funding works in China. So in the US, you kind of have most of this CapEx is coming from US tech companies. Whereas in China, certain things like building out data centers is actually done by state-run telecoms companies, for instance. So Chinese tech companies have a much more asset-light approach, so to speak. So then when you look at a more aggregate figure in terms of kind of IT investment, and obviously, just to mention, there's quite generous subsidies and state financing in China as well. That gap still exists. It's difficult to get exact numbers because there aren't precisely comparable figures. But I think that the upshot is that it looks like Chinese investment lags US investment by a much smaller margin. Now, that gap still exists, obviously, so that does constrain China's ability to push beyond the frontier and lead the US. But it plays it quite well in terms of its ability to catch up to existing US tech.
I want to get onto that question of subsidies, but before I do, you mentioned the importance of energy in terms of energy capacity, in terms of diffusing the technology through the economy. I'm struck by the fact that our views on the US economy this year are that growth will be above consensus because, in part, of the AI boom. And our forecast for China this year is that growth is going to be below consensus despite what's happening with the AI story. In fact, the AI is going to help support growth, but not nearly enough to counter all of these structural forces that are weighing on the economy. Why isn't the Chinese economy seeing the kind of benefits that the US is? Where are we seeing the signs that AI is supporting the Chinese economy?
Yeah, I think, as with kind of model development, China does seem to be a few stages behind the US still. And that applies also when we're talking about the economic impacts of AI. One of the big things to highlight is the contribution of the ICT sector to GDP growth, for example. In the US, we've seen a huge surge kind of since the start of 2025. It was picked up massively. And in China, the ICT sector contributes a fair bit to GDP growth, I think in the range of 1 percentage point in Q2 of last year, which is kind of similar to where the US is now. But in China, that held steady for the past few years. So we haven't seen that massive increase. So that hasn't driven up broader GDP growth either. I think the key reason that we've seen this surge in the US and not in China comes down to data center build out. So the US has just been rapidly building out these data centers, even as I mentioned earlier. when they don't necessarily have the electricity grid capacity to bring those online. And what that's meant is just this surge in investment that's boosted GDP growth. In China, you haven't seen that as much. One of the big constraints there, again, it all comes back to the chips. So obviously we've got these export controls, or had until recently, that limited China's access to top NVIDIA chips. And Beijing is also playing a role in trying to constrain access to those top chips for Chinese companies. And then the other issue is that domestic chips in China, even the best ones, are in quite short supply. So even though there is demand for data centers and build out, you haven't seen as much of an investment boom there. And that probably goes a long way to explain the gap between the two. But I would mention that top AI chip producers in China have said that they plan to triple their chip output in 2026. It's unclear if that's possible or not, but if they do pull through, then that bodes quite well for the AI build out in China.
What about on the productivity side? Are we seeing anything like we're beginning to see in the US?
Again, I think China's still a bit behind on that front. So we haven't really seen any obvious signs of a productivity boost. Given our quite optimistic view about AI in China, that's definitely down the line somewhere. But I would caution that we do think the adoption rates in China of AI will be quite impressive, but that might not translate into a as big of a productivity boost as we might see in the US. That comes down to the state-led nature of this AI push and AI rollout. So, you might see firms incentivized to show that they're adopting AI, even if it doesn't necessarily boost productivity significantly. You could also see big state-owned enterprises, being encouraged to adopt AI and gaining broader productivity benefits from it, but then also facing pressure to keep employment rates elevated. So you might see, even though there is some sort of on paper within company productivity boosts from AI, because you're not seeing that resulting fall in employment in those areas, you're not actually seeing a productivity boost in the economy as a whole. So I think what's going to be really interesting to watch play out over the coming years is how the difference between the state-led rollout in China and the more kind of private sector-led rollout in the US will impact productivity statistics and differentials between the two countries.
You look at AI and, obviously very strong echoes of what happened in EVs and what happened in solar. Before that, you can see that centrally directed industrial policy leads to these massive inefficiencies that actually counter the productivity improvements.
One of the interesting points there is that, you get this massive state-led push, loads of investment from the government that accelerates AI adoption, build out, rollout, which I guess is a positive in a lot of ways. It also means that kind of a lot of these AI products in China are way cheaper than those in the US or in any other economies. And it means that China can export this at a really competitive price. At the same time, you don't necessarily see the same productivity benefits that you get in other countries. So you highlight EVs as an example. China's EV industry is world leading. Its technology is world leading. It's exporting to the entire world. But at the same time, you've got, loads of domestic EV makers that never even made a profit, benefited from these massive state subsidies. And kind of all you get from that is loads of cheap exports and domestic rollout, but not necessarily the proportional productivity boost that you'd want to see. And I think it ultimately kind of comes down to the balance between the leadership's competing goals. So obviously, on the one hand, they want to boost GDP growth. And when you're talking about AI, that's about boosting productivity. But at the same time, they want to ensure domestic self-sufficiency. And to do that, you need to subsidize domestic manufacturers. And then they also want to use AI as another way of ensuring some degree of geopolitical or global dominance. Maybe dominance isn't the word, obviously. We talk about these US blocks and China blocks, but I think AI is probably going to become another major fault line in broader geopolitical fracturing we've seen in recent years. And in order to get other countries dependent on Chinese AI, you need to be able to provide it at a competitive cost. And that's part of what all these state subsidies are helping to achieve.
Leah Fahy on the China and US AI race and its impact on the Chinese economic outlook. Her report will be linked in the podcast notes. I will also add a link to our dedicated AI page, which has all our key analysis, some data tools, and much more besides. But that's it for this week. We will be back next week with much more from the world of macro and markets. Until then, goodbye.